Welcome back to another episode of Milkshakes, Markets, and Madness, where we talk about the financial markets, the madness surrounding those markets, and we often do it through the lens of the dollar and milkshake theory. And we've got some madness again this week because, as per usual, no matter what happens in the world, it is always a game changer that is going to bring an end to the US dollar. It's going to bring an end to US hegemony. It means the US empire is going to fail. And all of us who have predicted otherwise are finally going to get what's coming to us. Now, if this sounds like news to you, you haven't been watching this show very long, because we have to deal with this nonsense week after week, month after month, year after year. And of course, once again, this week, a big game changer was announced, which I was forwarded several emails and direct messages on Twitter and tagged on Twitter posts, because apparently now the rest of the world is going to swap out of all of their US dollar debt. They're going to transform it over to another currency, specifically the yuan, where they're going to pay a lower rate. And this is going to be good for the borrower. It's going to be horrible for the United States. And it is once again a game changer that is going to dethrone the United States and the US dollar. So that's what we're going to talk about today. Let me bring it up here. So this was the headline that came out of the Financial Times. And of course, the usual suspects jumped on it and said, this is it. This is it this time. Get ready. Never mind the fact that, things like this have been announced all the time, week after week, month after month, year after year. And these game changers never actually end up changing the game, but it is exciting for them and they get to talk about this. So the first thing I would say regarding this is, they're talking about how getting out of United States dollar debt is supposed to be the game changer. And I find that pretty interesting because 9 months ago, China swapped into US dollar debt. And when they issued this bond in US dollar terms, it was hailed as the game changer because they had flipped US dollar hegemony into their favor. So why is it that China going into US dollar debt is a game changer, and other countries leaving US dollar debt is a game changer? I mean, I think they got to figure out which side of the argument they want to be on. When this happened, when this China bond was initially happened, Kathleen Tyson, who is obviously, for anybody who's followed her, knows that she's a big proponent of the BRICS and China and Russia and the rise of the non-West financial system. And she claimed that this was a classic judo strategy by China and talked about how they were issuing bonds at a lower interest rate than the United States. But Richard Casey, I put this up here because a lot of people will comment on stuff like this, but really have no idea what they're talking about. But Richard Casey is actually somebody who worked for a very long time on Wall Street and in the city of London. And he was a portfolio manager. He was a strategist. He was an economist. He priced bonds. He traded bonds. He managed bonds. He worked in macro. He worked in emerging markets. He actually has decades of real world experience in how this stuff works. And so I would encourage you, if you like this type of stuff that we're talking about, to follow Richard. And whenever one of these things comes out, go to his feed, see what he is saying about it. And if he's not saying anything about it, forward it to him and ask him his thoughts on it, because he will give you a real world answer rather than some made up theory. So I'm just going to read to you what he wrote because he can say it better than I can. But he basically said so much wrong with this, referring to Kathleen's tweet about, this classic judo strategy from China. He said the China US dollar bond issue was not sold at a lower yield than treasuries, but at a small positive spread to treasuries. The chart she links is to CNY government bond yields. The current China US dollar government bond index is 85 basis points over treasuries. This issue traded much tighter because it was small symbolic issuance of $2 billion. This compares to China's $2.5 trillion external debt. So it's a very small issuance. And although the bond was issued through Saudi Arabia rather than Hong Kong as normally done, a large number of the buyers were Chinese because they don't pay tax on the interest and would much rather hold dollars than CNY assets. Chinese state banks likely also were buyers to assure the deal's success. The rest of the demand came from a wide range of international investors. It was not sold directly to Saudi Arabia government. So Saudi Arabia was not the buyer, as many people indicated that it was. And he goes on to say, it's rather bizarre to claim that China lending US dollar to the global south increases their debt, reduces the chance of a 1980s style debt crisis. Hasn't worked too well for Venezuela, Ecuador, Pakistan, Sri Lanka, et cetera, et cetera. In any case, I bring this up because this nonsense is going on again this week. And if you want some real world rational commentary about this stuff, seek out Richard, because he's a pretty smart guy. But listen, this story is out there. So what is it actually about? What is the headline about? So it is potentially happening. Many of the things that they talked about is in the negotiation stage. But why would countries want to swap out of the dollar debt? Well, part of the reason they want to swap out of the dollar debt is all the stuff that I talk about on this channel all the time. And I think one of the reasons why you guys tune in, because dollars are hard to get. And it's actually causing them pain to try to come up with the dollars to try and pay them. But before I get to that, let me go back to, why are rates even low in China in the first place? Why are they able to borrow at a lower interest rate than the dollar interest rates? Okay, first of all, the reason rates are very low in China, a lot of times people will say that they have a lower cost of borrowing, and therefore it shows that they are less of a risk to the global community. But that's not the case at all. The reason rates on China's 10-year bond are so low is because they are primarily owned by local Chinese investors, Chinese banks, and the PBOC. None of these entities want to risk their own balance sheets because China is in a very large deflationary environment right now. They've got a real estate bubble that has broken. They've got a deflationary spiral in that sector. Plus, as Richard noted, in our previous slide, they get a tax break when buying these government bonds, and in some cases, the banks are mandated to buy them. And not to mention that the PBOC has basically been doing QE, or at least some form of it for much of this year. That is why rates are low in China. Less than 5% of China's outstanding debt is owned by external entities. So the idea that the rest of the world is rushing to buy Chinese debt, and that's why it's so low of a yield, is just, it's not reality. So keep that in mind. But that is why rates are lower in China. But why are they swapping out of the US dollar debt? And they're saying developing countries. So that's not developed countries. So what they're really talking about is small EM countries, okay? And the reason they're doing it is because they're struggling financially and can't come up with the US dollar to service the debt. So they're trying to figure out ways to decrease their borrowing costs. And this is a lot of what we've been talking about for many years now on this channel, is that as the dollar is stronger versus these currencies. So some of the countries they're talking about here are like Sri Lanka, Kenya, Panama. And so those countries' currencies are weaker versus the US dollar. And, not only that, but the interest rates is high because they're emerging markets, not necessarily because US interest rates are high. I mean, they are priced off US interest rates, but as an example, Kenya, who is one of the countries referenced, they did 2 refinancings over the last couple of years, and I think the interest rate on one of them was just under 10%, and the other one was just over 10%. And that's not because U.S. rates are so high; it's because Kenya itself is a counterparty risk, and so they have to pay a high amount. But this again, Kenya. You cannot take a small emerging market country and one deal that country is working on to refinance its debt in another currency and then extrapolate it to mean that the rest of the world is going to do this or is doing this or is about to do this. It's one thing to have a possibility of something, and it is possible that this is going to happen, but to take a possibility and to extrapolate it into a high probability event and go out and tell everybody that this is what's happening in the world, it's just, it's nonsense. And I'm sorry to be so blunt about it, but there's no other way to say it. But just pull up a newspaper, go on Google and pull up what's going on in Kenya, because millions of Kenyans are facing financial hardship as the cost of living outpaces their wages. This is just from a week ago, not even a week ago. Or the New York Times a month ago, is desperate to pay off their staggering debt, and its workers are paying the price. This is what they're struggling with. They're struggling so much with financially that they can't come up with the dollars to finance their dollar debt. So they're trying to figure out a way to get out of it. And the specific one that they referenced in this article was a dollar loan from China. So of course, China doesn't want to get nothing. And so they're trying. So maybe China will extend them and let them refinance it in yuan, right? And so, but again, you just go through the headlines and listen. You can do this for Sri Lanka. You can do it for other countries that are referenced here. Again, this is not a power move by the borrower. This is a borrower in desperate times trying to come up with a clever solution to get them out of it. It just goes on and on. But not only that. Again, if a country is going to swap out of the US dollar debt and into something else, why would they do that if they thought the US dollar was going to plummet? So again, most of the people that are saying this is this game-changing event are also the extreme dollar bears who think the dollar is going to go much, much lower. Well, if the dollar is going to go much, much lower, why would you get out of that as a currency or as a debt? If the dollar is going to fall, you want to keep that as a debt because it makes it easier to pay off, not harder to pay off. That would give them a financial windfall. So again, which is it? Is staying in US dollar debt the game changer, or is getting out of US dollar debt the game changer? And the reality is these people switch back and forth so often that they don't even know the answer to their own questions anymore. But here's Richard again, and I'm just going to read this because he says it better than I am, and he's referencing this Financial Times article, and he says it's an amazingly bad take from the Financial Times, and of course, Luke retweeted it. He says, imagine using Kenya and Sri Lanka restructuring bilateral BRI loans from China that go directly to Chinese companies for infrastructure products as cases of typical voluntary EM borrowing. This is what I was referring to earlier. You can't take this one example and extrapolate it across all emerging market countries, and that this is something that they're willingly doing. In the case of Sri Lanka, possibly Kenya as well, they were forced by China to do this to convert the loans to yuan. Whether they actually save money will depend on the ability to hedge and the yuan. They will still be forced to convert scarce US dollar reserves to yuan since they have no yuan revenues. Similar to the nonsense of Russia requiring payment of gas to Europe in rubles. Well, the fact is the way people get rubles is they sell them euros. So it's just adding one more step into the thing. But everybody hailed that as another big game changer. And he goes on to say it's hardly uncommon for EM borrowers, like any borrowers, to issue in multiple currencies. It is usually done more to expand their investor base rather than any possible marginal savings in interest expense after FX hedging. The article even states that in the long run, such borrowing cannot replace the larger public market for dollar bonds. So again, it's somebody taking a headline and extrapolating it out and making it into some game-changing event. So listen, you obviously know my opinion on it, but I hope the reason you come on here is to at least try to educate yourself and get an understanding of what's going on. So whenever you see these headlines, one of the things you should always ask is, why am I reading this now? What's happening? Why is this on the front page of the news right now? But the second question you should ask is this true? Because just because it's written in the paper and just because the headline says it one way, does that mean that that's the actual story? And even if it is true, I'm not saying it's not, it doesn't mean it's necessarily wrong. But what you should do is you should always try to understand the other side of it, or what's the other side of the argument, or what would somebody who disagrees with this headline say? And then after you've understood and listened to both sides, then come up with your own way of thinking. So I don't necessarily want you just to believe me. I don't want you just to necessarily believe Richard. I don't want you to just necessarily, believe the Financial Times or whoever else tweets this out. What I want you to do is educate yourself and understand both sides of it, and then come to the conclusion that you think is the most likely. And it's usually not the one that's the most dramatic headline or the most dramatic answer. But this type of stuff is everything that we talk about on this channel, but it's really what we focus and write on our Santiago Capital research. So if you haven't already done it, hit the like button on this, subscribe to this channel, but then go over to our research site, take a look at what we have. We've got, two different levels, the regular paid level, and then we've got the premium version. I think you'll like, if you like this show, I think you'll like the offerings that we have there. This topic that we were just talking about currencies being borrowed or countries borrowing in foreign currencies. This is really what the milkshake is all about. The milkshake is all about the fact that the rest of the world has borrowed in a currency that is not their own. And as that currency rises, it causes all kinds of problems. That's really the essence of a carry trade. And every time we have had an emerging market or even a global financial crisis or some kind of an economic downturn over the last 40, 50 years, oftentimes, if not all the time, there is some element of a carry trade gone wrong in there. It is often caused by one country that borrowed in one currency that they didn't control. And then when it went up against their currency, it got them into trouble. That's exactly what's happening with Kenya right now. We actually wrote a big report on this last fall in our premium Substack or in our premium offering. And I just pulled out the table of contents here. What we did is, what we often do is we'll come up with a big topic like this, like a carry trade. And what we'll do is we'll talk a little about the background of it. We'll explain what it is. We'll give a couple historical examples, and then we'll go into a deep dive on one event. In this case, we went into a deep dive on the carry trade. But this is exactly the type of stuff we write about. So if this is interesting for you, I would encourage you to sign up for it. Because the other thing, as I mentioned last week, we're going to do a presentation on what we think is going on with stable coins. And to be able to view the presentation, you're going to need to sign up for one of the levels on Substack. And so that's probably going to be coming towards the end of September. We still need to finalize the report and the presentation, but we're putting our thoughts together on that now. So in any case, again, I would encourage you guys to go over and check it out. If you like this type of topic, this is the type of stuff that we are often thinking about and then writing about. So now we're going to go over some charts. So rather than, I'm actually just going to pull up my Bloomberg. Let me just pull this up. Let me remove that. Boom. Okay. So again, for those of you who have been watching for a while, know that I have been very concerned about the markets for the last couple months and have been expecting a pullback that has not come. But as I said, I think it was last week or the week before, I actually, and I've said this on a couple podcasts now, is I think that we're not getting out of September with a pretty significant shock and pullback. Now, whether that ends up only being 5% or whether it's as much as 10 or 15, I don't know. But I think that's where we're at. And oftentimes, people in my profession are always told, never make predictions, just talk in generalities. You talk about things you're concerned about or the things you're thinking about, but you don't need to say whether something's going up or down. And if you do say something's going to go up or down, you certainly don't put a price target on it. That's the last thing you want to do. You don't want to give a direction and a price target, because then, then you're in the prediction business and it never works out. And by God, if you do the first two, certainly don't put a time frame on it, because that's the triple, that's the triple snake bite that never ever happens. So what we're going to do today is we're going to break all three of those rules, and I'm going to go through these charts and I'm going to tell you what I think is going to happen. So any of you who have watched this before know that I kind of like to use I like to use a yearly chart, and I just like to see where we're at. So this is the Dow Jones right here. Hold on, I got to pull it up on my screen now as well. So this is the Dow. This is a 1-year chart, and The top is the price. You can see the moving averages here. In the middle, we have relative strength, and at the bottom, we have the stochastics. Now you can see that, for the last month or last 3 weeks, it's at the height, and it's just kind of going sideways. The stochastics started to roll down. I'm sorry, the relative strength started to roll down in July, but it hasn't crashed. It's just kind of stayed in the midterm range. The stochastics fell and then have come all the way back up, and now they're starting to come back down again. I think the Dow probably by the end of the month at least comes down to the 50-day moving average and potentially even breaks through both the 200-day and the 100-day. So I think we could easily have a 5% pullback in the Dow by the end of the month. And it would not shock me if it's significantly higher than that. Let's go to the SPY, which is just the ETF on the S&P 500. So again, same kind of a thing. It's over the last 3 weeks, it's up slightly, but mostly has gone sideways. But over the last kind of 6 weeks, relative strength broke down. It's now kind of going sideways. The stochastics broke down, came back up, but now they're starting to kind of roll over. Again, I think I don't think the S&P is getting out of the month unscathed. Wouldn't shock me at all to come back down here to both the 150-day moving average or 100 and 200-day moving average. I think we probably get down to the 200-day by the end of the month. Now, can I be wrong on this? Of course I can be wrong on this. And I'm not telling everybody to go out and sell all their positions. I'm not telling you to go out and short the market. What I will tell you is that I no longer just have hedges. I actually have positions. Those of you who have watched knows that hedges you don't want to pay off, positions you do. So if this doesn't happen by the end of the month, it's going to hurt. That's all I can say about that. But I think we're on track, and I think it's going to happen. Now, if we look at the QQQ, which is the NASDAQ, again, you go all the way back to the end of July, the market, it's only up a tiny bit since the end of July. But you can see the relative strength broke down there. It's kind of bounced sideways, and the stochastics have rolled over. In other words, the momentum is gone. Price is hanging on by a thread. The momentum is gone. And again, I think we could easily get down to the 200-day moving average by the end of the month. And that's about a 9 or 10% pull down from here. But, I'm not just bearish on the U.S. And I should say, I'm not predicting 1929. I'm not saying that we're going to have a financial crisis. I just think it's time that we have a correction. And I think in many ways, everything is already priced into the market. I think the Fed's probably going to cut next week or the week after next. I don't think it really matters. I think it's already priced in. And I think if there's any euphoria as a result of rate cuts, I don't think it lasts more than a couple days, maybe not even a couple hours. So I do expect the market to not like whatever it is that the Fed does. But this isn't just about the United States either. Again, I always say this is not going to happen just in the United States while the rest of the world does fantastic. I think the rest of the world is starting due for a pull down as well. This is the DAX. Now, the DAX has had a heck of a run. Look at the DAX over the last year. I mean, it's a fantastic move, right? But same thing. The relative strength kind of started to roll over. Oh, sorry, I got to pull this out a little bit here. The relative strength broke down back in the spring, and then it bounced back up. And so really since the beginning of June, the DAX has kind of been going sideways. But look, it has already broken the 50-day moving average and the 100-day moving average. I think it easily comes down to the 200-day moving average. Again, you can see momentum is completely gone and the relative strength is falling. I just don't know what the Fed could do next week that would be so bullish that the market is not already expecting. Now, is it possible? Of course it's possible. But again, I think we're at this, and not to mention the seasonality. The VIX is back at 15, and this is typically a part time of the year where the volatility starts to pick up. But let's look at Taiwan. I think Taiwan's another one. Taiwan has just had a fantastic move out of the April low. its relative strength kind of broke down a couple of weeks ago, and it's just kind of going sideways. But again, the momentum is just gone, and easily could come down here and test the 200-day moving average. Microsoft, you guys have heard me talk about Microsoft a lot. Microsoft has started, it's actually broke down at this point, and in my opinion now it's just a matter of how low it goes. Again, I think it was a pretty important close on Friday because it closed below the 50-day moving average here. And now I think it easily goes to the 100-day, and it would not surprise me at all if we get to the 200-day moving average. Again, we stayed above the relative strength overbought for really almost 3 months, and it kind of finally broke down at the end of July, early August. You can see that the stochastics have just collapsed. Now, some people would say, that the stochastics are that low, it's probably time to start buying. I would say that would be true if the relative strength had already crashed, but it's not. Relative strength, it's coming down, but it hasn't crashed. And just because something's really low doesn't mean it has to rise. And just because something's really high doesn't mean it has to fall. Again, we can look and see how long it's stayed down at this level for over a month back in the spring. And then it stayed overbought or up here, for 3 months. So there's nothing to say that this couldn't just go along like this for a while. And, I think Microsoft closing below 500 on Friday was a big deal. Let's look at it from this way, because I looking at these charts as well. Again, we had, I like looking at candle charts because it's kind of easier to, just look at this stair step higher, boom, 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 boom. Every week, just higher, 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 higher. But if we do this but then it finally broke down about a month ago, like I said. But if we look at it on a daily chart, not only has it broken down, it's also now kind of broken through this level. Now, you can't really say this is a head and shoulders, but if you could kind of see a shoulder there, the head here, and potentially a shoulder here. So, it wouldn't surprise me at all to kind of see this come down into here. I think we could easily go to 450. Would not shock me at all. And don't forget, we have this big gap sitting down here that's wide open since April. Now, whether that happens in the next 2 weeks or not, I don't know, but could be interesting. NVIDIA, same story with NVIDIA. And part of the reason that I think that the Dow, the S&P, and the NASDAQ could fall is because these big market cap companies, Microsoft, NVIDIA, et cetera, they're starting to break down. If they break down, the effects of passive management will take the overall indexes with them. But when we look at NVIDIA here, it broke also below its 50-day moving average. I think it could easily go to the 100-day. No problem at all. Again, the momentum is completely gone. And I don't know what they're going to have to do to get that momentum turned back around. We've talked before about it's like riding a bike up a hill. Once the momentum is gone and you stop halfway up the hill, if you stop halfway up the hill, it's hard to get that bike going uphill again. And if you start down the hill, it's even harder to turn it around and get it up that hill. So I think I think we're due for some lower prices on NVIDIA. And again, if you kind of look at, this is just a candle chart, but if you go all the way back here, and it would have just a very good trend, and then over, in August it kind of broke down, and again, I can't really argue and say that this is a head and shoulders, but if you could almost say that's a shoulder, that's a head, that's a shoulder, and now we're coming back down. Let's see, what else can we look at here? Oh, Goldman Sachs. I think Goldman Sachs is going to fall a lot. So, again, same story. It had a huge run up into the summer. Relative strength broke down. The price has gone up a little bit over the last month or so, but not a lot, mostly sideways. But momentum and stochastics have kind of rolled over a little bit. I think we could easily have Goldman Sachs back in the mid 600s. I don't think it would take a whole lot for that to happen. Now, let's talk about gold and the mine. I mean, listen, anybody who's been in the miners this year has made a heck of a good profit. I'm not going to come out and tell everybody they should sell all their gold miners, but I would be very, very careful if you're thinking about buying them here. The stochastics can't get any higher. The relative strength can't go a whole lot higher. And anytime you see a move up like this, you're just waiting for it to come back down. Now, to be clear, I'm not saying it's going to crash. I'm not saying this is the overall end of the move. I'm just saying this is not the time to be loading up on that type of. Now, can it continue to run? It can absolutely continue to run. What I'm saying is if you haven't bought it yet and you go and buy it now and it drops 10 or 15% in the next couple of weeks or a couple of months, you deserve the pain that you're going to get, because this is a hard time to be entering for the first time and expect to make big profits. Not impossible. It's just difficult. Well, then let's just look at let's look at it on gold itself. Let's see what it is. Yeah, kind of the same thing, right? It's at an all-time high. Relative strength is way overbought, and the stochastics can't get any higher. So, just be careful out there. And then, well, let's just look at what's coming up this week. So the next week is not this coming week. The week after is the Fed meeting. My guess is that this week, there's a lot of data coming out this week. My guess is that this week will be kind of sideways to down a little bit. I think as we get towards the end of the week, it would not shock me if either CPI or some of the stuff late in the week comes in a little bit hotter than expected. So potentially we could have a little pull down later in the week. My guess is that things would then rise next week, either into the Fed meeting or rise on the Fed's announcement that they're going to cut rates, because I think they are going to cut rates, and I would expect initially on the nose or on the noise of it, maybe markets go up. But again, I think it's mostly priced in at this point. And my guess would be by the end of next week and into the following week, the week of the 22nd or whatever that is, I would expect markets to be headed back lower. So that's where we're at. We're going to have to wait and see what happens, but I don't think September is going to be boring. And with that, I'll leave you guys to have a good weekend, and we'll be back next week. And stay safe out there. Bye, guys.